Okay, let's get started. Just to show us again, show everybody again how this lecture on intermarket analysis fits in the grand scheme of things. Let's just go back through the four kinds of indicators that we discussed in this class. First half of the class up to the midterm was all about trend and momentum indicators. Those are the indicators that deal with price and volume. Their pattern identification, moving averages, etc. Those kinds of indicators tell you the direction a market or a stock is going and the force behind the move. So our momentum indicators will tell us, the rate of advance. The trend, we determine trend is up. We can do that with trend lines or least squares lines or moving averages. Our momentum indicators tell us whether the trend is accelerating or decelerating. They give us some insights as to whether we think something's going to break out or not, etc. But they don't tell us very well necessarily where we are in the trend. This leg of advance looks more or less like this one, and this is earlier in the advance. This is later, so it would certainly be useful to have indicators that give us some insights as to where we are, and that's why we look at sentiment indicators or market psychology and supply-demand indicators or flow of funds. And we'll go over this again later, but those kinds of indicators tell us who's bullish, who's bearish, how bullish and how bearish different market participants are. And the reason that's important is that some market participants are motivated by price and value, investors. Some are motivated by the trend, so they are active at different points in the trend, and that therefore tells us or gives us some indication where we might be in the trend. Now, intermarket analysis, what we're going to talk about today, is about how other markets affect the supply-demand situation for stock. And all equity alternatives fit into this category. What's an equity alternative? Cash is, bonds are, commodities are. There are all kinds of other things that we don't have a lot of data on. Real estate is, and art is, or whatever. So as the price of equity alternatives change, let's say the price of bonds go up, that makes bonds relatively less attractive because they've gone up in price, and that makes stocks relatively more attractive, so it pushes the supply-demand curve for stocks up. Price of gold goes down, all other things being equal. It depresses the supply-demand curve for stocks because it makes gold relatively more attractive, and so we just tip this supply-demand curve the other way. So that's how the four kinds of indicators fit into the whole scheme. The most important alternative to equities is of course, the bond market. And so this lecture is more concerned with interest rates than anything else. And there's a lot of misconceptions about how interest rates and stocks are related to one another. Okay, this picture shows, two cycles. And since I've labeled it, or I'm calling it stocks versus bonds, well, obviously, one must be stocks and which one must be bonds, right? So which one is stocks and which one is bonds? Now, you've read the notes, you should know which is which. Which is the bond? These are two cycles. What's the relationship between these two cycles? Is there an engineer in the crowd? What's the relationship between these two cycles? They look the same, right? But they're out of phase, right? One is leading. They have the same shape, but they are out of phase. Okay. So most people would say, aha, nobody said anything here. The dotted line must represent bonds because bonds lead stocks. We have a bond peak and then we have a stock peak, et cetera, et cetera. That's the most common knowledge that people have about these markets. And so people tend to label them this way. But if all I do is talk in terms of interest rates instead of bond prices, now we have stocks leading interest rates. What is I? I is 1 over B, right? Interest rates move inversely to bond prices. So while bond prices might lead stocks, stocks lead interest rates. So how can that be? If I just change the name of something, that it turns it upside down. Why is that? It is that way because neither lead. And the best way to understand it is to talk in terms of prices, bond prices and stock prices, and go through an economic cycle and try to figure out what's going on. So I've divided the two cycles for bonds and stocks into 4 phases. And the 4 phases are identified by the inflection points. Low in bonds, low in stocks, high in bonds, high in stocks. So I've divided a market cycle and an economic cycle into 4 phases. And so let's just take a look at what's going on. Let's start with phase 2. We have soaring bonds and soaring stocks. What do we know about the economy? What's going on in the economy? Interest rates are plunging, right? Bond prices are going through the roof. So what's the economy doing? Must be weak, right? If interest rates are falling, right? So so why are stocks going up if the economy is weak? Stocks are going up because investors believe that the fall in interest rates is going to be bullish for the economic environment. So in phase 2, investors are buying stocks despite the fact the economy is weak because they believe the fall in interest rates is ultimately going to benefit the economy. Well, we move into phase 3. What's happening here? Bonds are rolling over. So what do we know about the economy? It must be strengthening, right? Rates are starting to rise. Stocks continue to go up. Why? Because now stocks are reacting to the favorable earnings environment associated with an economic upturn and are ignoring the rise in rates. Phase 3. And don't dwell on the numbers. These cycles can be numbered anything. We just want to know what's going on. In fact, on the test, it might not have the same schematic, so don't remember the numbers. Know what's going on. Okay, so now bonds have rolled over. Stocks are still going up. Ultimately, stocks follow and stocks roll over. Now, what's happening in the economy? Well, we know it's strong because the bond market's getting killed. Interest rates are rising. Why are stocks going down in the face of a strong economy? Because now investors are worried that the backup in interest rates is going to choke off the economic expansion. So in phase 4 here, they're both going down together. Ultimately, bonds bottom out and stocks continue to go down. Bonds bottoming out, what do we know about the economy? It's starting to weaken, right? Rates are starting to fall. Stocks continue to go down because the current earnings environment is unfavorable. So in phase 4, stocks ignore the drop in interest rates, and investors now are focusing on poor earnings. So what does that mean? That means if we go through the cycle, we see there's a period where bonds and stocks rise together. There's a period where bonds go down and stocks go up. There's a period where they both fall together. And there's a period where bonds go up and stocks go down. So the notion that all you have to know is which way the bond market's going and you'll know what the stock market's going to do is hokum. So you see this on TV all the time, the great prognosticators giving you a call on bonds and saying, therefore, stocks and such and such. What's important is the relationship between the two markets. Where are we now? Where are we now? Come on, somebody take a guess at where we might be. Pardon me? Well, rates have bottomed, right? So the bond market, we know the bond market has started to advance. It's arguable about whether the stock market has seen its low. You might think it has. So where are we? Well, we're hopefully moving from 1 to 2. You know, it's not clear at the moment if it's 1 or 2, but it's one or the other. Rates are down a lot, and stocks made their low just a couple of weeks ago. Might be the final low. We've got to lose a lot of other indicators to make that judgment. So we've learned a lot. We know exactly where we are right now in the markets. Right? We also know that there's probably going to be a big fall, a further fall in rates to produce a big rise in stocks. That happens to be my opinion, by the way. And we know government rates are down a lot, but corporate rates haven't fallen much at all. So right in here, we certainly, we might have moved into two, but it's certainly not clear that we're in it at this point. So now let's take another look at these two cycles again. The notion that stocks lead bonds or bonds lead stocks. Right here, stocks are falling, forecasting a rise in interest rates, or a rise in bond prices, a fall in interest rates. Falling stocks leading rising bonds. Rising bonds leading rising stocks. Rising stocks leading falling bonds. Falling bonds leading falling stocks. Falling stocks leading rising bonds, right? So as you go through a cycle, one leads, then the other leads, because it depends on where you are. And the best way to understand the relationship is to forget which one leads and which one doesn't. Stocks are a leading economic indicator. Interest rates are a lagging economic indicator. And if you understand that, then you'll know why they move in this direction. Stocks are a leading economic indicator. Interest rates are a lagging economic indicator. There are periods in the cycle where bonds and stocks go up together, periods where they go down together. There's a period where bonds go up and stocks go down. There's a period where bonds go down and stocks go up. It depends on where you are. So the relationship between the two markets is more important than precisely which one may not be leading. Because, well, let's just say right here, in this phase of the cycle, what kinds of stocks do I want to buy? Stocks are rising, but interest rates are plunging. I probably want to buy interest rate sensitive stocks, which are known as early cycle stocks. Here, well, I don't want to buy interest rate sensitive stocks anymore. Rates are starting to rise. So I probably want to buy cyclical stocks right here, or what are called late cycle stocks. So the relationship not only tells you something about the markets, tells you about what kinds of stocks you might want to buy or not want to buy. Another way of looking at the relationship is to draw a curve here that represents the expansion and contraction of GDP and marking on it where bonds peak, stocks peak, and using gold as a proxy for commodities. We could have put a C here for commodities. This chart comes from Marty Pring's book, Technical Analysis Explained, and he uses gold as a proxy for commodities. It might move around a bit depending on which particular commodity we're looking at, but that's not what's important. What's important is that you can see that as you go through an economic cycle, bonds peak, stocks peak, commodities peak, bonds trough, stocks trough, commodities trough. Stocks are a leading economic indicator. Interest rates are a lagging economic indicator. Commodities are a coincident economic indicator. Now, it's tough to see exactly using gold, but that's the relationship that persists most of the time. Why would that be? Well, we know stocks lead because investors buy stocks in anticipation of something good or something bad happening, right? Commodities reflect what's actually going on in the economy. Yeah, there's always a speculative element in all the markets, bonds, stocks, commodities, but let's face it, I mean, most commodities are bought or sold with regard to whether people actually need them for use in the economy. So most of the time, stocks are a leading economic indicator, commodities are a coincident economic indicator, and interest rates are a lagging economic indicator. And since interest rates are a lagging economic indicator, that makes bonds prices lead. So remember that bonds are the inverse of interest rates. It's easiest to understand the relationship talking about prices, bond prices and stock prices, but interest rates are 1 over B, the inverse of B. And so stocks lead, interest rates lag. And of course, this chart also comes from Marty Pring's book. And here he's drawing 3 separate curves representing stocks and bonds and commodities. I'm not going to make you responsible for understand. This is pretty complicated when you look at it this way, but I'm just showing the chart to give you the message that the cycles are interrelated, but they are different, right? Okay, and here's some markets in real markets, using 30-year treasuries for bonds, the CRB Index for commodities, the S&P 500 for stock prices, and of course we have a fourth market here, currencies. It makes it really complicated, but forgetting about the green line for a moment, you can see pretty accurately on the chart what bonds are doing inversely to stocks. We have a trough on treasury prices in here, trough in stock prices in here. CRB Index, we've been in kind of a secular bull in commodity prices at this time, so this is a little trickier to read. But the bottom in the market is in here. If you look at these are the 0203 bottom in the S&P. Commodities on this index made their trough a little beforehand, but you can see how powerful they moved. They moved during the economic expansion. So the CRB index didn't reflect what I said exactly, but pretty well, considering it's just one measure of commodity prices. Now, currencies are on here. How do currencies relate to this? We can have a bull market with a strong dollar, or a bull market with a weak dollar. So it's just an additional piece of confusion for you, if you will. Here's a chart where we're looking at just bonds and stocks, and you can see that most of the time they're moving inversely. Let's see it a little clearly in here, but here we have a big rise in treasury prices during a decline in stocks. Stocks start up, interest rates, basically have started up. Here's your trough is in here, and of course, interest rates trough, but they didn't go up a lot. Just because the stock market's rising, and we know that means the economy somewhere along the line here, the economy must have done a little better. The fact that interest rates didn't go through the roof, or the fact that the bond market didn't collapse, even though it did peak, is important, because the longer it takes rates to rise a lot, the longer the bull market's going to last. So here we have if we go back to the original chart where we had rising stocks and falling bond prices. This is going on for a couple of years. Remember phase 3 on my chart? It was a small area on the chart, but it can be it can be wide, or it can be narrow. It turned out to be, in this cycle, or this past bull market cycle, it was a rather lengthy period where rates started up and stocks continued to go. So that phase 3 took a long time in this last cycle. Most of the time, interest rates and commodity prices will move in the opposite direction. And here we have, let's see if we can spot it here. Here's the trough in commodity prices. The peak in the bond market was, pretty close. Again, strong commodity prices. Bonds didn't crumble. but the trough in rates was up in here, which was just after the bottom in commodity prices. Most of the time, they're going to move in opposite directions. Can take a while before one of the other markets has a big reaction to it. So part of the reason for the big bull market, 03 to 07, was the fact that we had rising stocks, we had rising commodity prices, but interest rates only grudgingly went up. Most of the time, commodity prices and the dollar go in opposite directions. Anybody know why? Why do you think that would be?
Major commodities such as gold and crude oils are denominated in US dollars.
Right. Most, in fact, virtually all commodities trade internationally. And gold, of course, is the big one. Oil is the next big one. But so all the metals trade in dollars too. In fact, if you bought aluminum on the London Merc, it's traded denominated in dollars too. So the reason they move in opposite directions is that most commodities are denominated in dollars. And of course, it shows up even more clearly in gold. Although the dollar can go up and gold can go up, what would the message from that be? Let's think about it. We know that rising gold prices is a function of, or a manifestation of inflation. But gold and the dollar can both go up together. Why? If we have global inflation, which guess what? That's what we've had in the last few years. The gold has gone up in all currency terms. The dollar has hung in there, and we can get the reasons don't matter. We can talk about what those reasons might be, but if you have a global debauching of currency, which is what we have right now, you can have strong gold in all currency terms, and the dollar can just sort of mark time. Dollars, has had very little pressure on it, a little bit in the last week, but for the first time, because there's a global inflation message or a global debauching of currency message. Now, here's an example where we have interest rate sensitive stocks. Utility stocks are quite interest rate sensitive for two reasons. Utilities borrow a lot of money, so borrowing costs are a factor. Utilities have above average dividend yields. So utility stocks are interest rate sensitive for two reasons, borrowing and dividend yields. So you would expect them to move similarly to bonds. And they do most of the time. It's not perfectly clear because stocks lead and interest rates lag, but most of the time these are going to be moving in the same direction. Okay, this chart could have been in the relative strength lecture, and I think in fact it was in the relative strength lecture. But this is sort of intra-market analysis, if you will. Intermarket stocks versus interest rates, stocks versus commodities. But we can do intra-market analysis. We can compare early cycle stocks to late cycle stocks. Cyclicals generally late cycle. And, when they're both rising, it's often not easy to see what's going on. They're both in bull markets. But you can see there are periods where one does better than the other. And if we go back, the bull market began in here. Let's see, where are we? This is the bottom right in here. So during the bear market, we had cyclicals generally underperforming, and then as a bull market gets going, the opposite it occurs. So we can use our intermarket analysis to make a judgment about commodity-sensitive stocks compared to interest rate-sensitive stocks. Cyclicals are metals and oils, and these consumer stocks are kind of defensive stocks. These stocks are sort of hurt by inflation. These stocks are benefit from inflation. So we can expect to see these kinds of stocks move in the same direction as the commodity markets. These kind of stocks generally move in the other direction. So, okay. So let's just go back to the most important thing about this lecture is right here, and we'll go back and we'll look at it again. Remember, stocks are a leading economic indicator, commodities are a coincident economic indicator, and interest rates are a lagging economic indicator. And the best and the most important alternative to equities are bonds. And so this represents the most important notion from Intermarket Analysis, is comparing the stock cycle to the bond cycle. And you might just see this chart on the final exam with you're going to be asked to compare these statements with a phase on the chart. Now, as I said, they might be numbered differently on the test, so you have to understand what's going on, and the chart is going to give you, you'll have this chart, well, which one? Maybe this one, I guess. You'll have this chart maybe 4 times, and you'll be asked to identify what's going on in the economy, or vice versa. So what's going on in the economy? Well, let's go back to where they're numbered again. So we start with, well, I guess we can start with, let's start with 1. In phase 1, what do we see? We see bonds bottoming out and stocks going down. So this means that interest rates are starting to fall, and the stocks are weak. So stocks are reacting to negative earnings. We've been in a poor economic environment, and bonds are beginning to benefit from that. Right? So at the inflection point where stocks turn up, we know the economy is still weak in this phase that's number 2 here. Bond prices are soaring. That means interest rates are plunging. Stocks are doing quite well. Now investors are buying stocks in anticipation of a more favorable economic environment because of the big drop in interest rates. Sort of what's going on now. We've got a very complicated environment going on right now. Fed is doing its damnedest to try to get rates down, and stocks are trying to make a stand. So, we're in somewhere in here. Move into phase 3. As interest rates start to rise again and stocks are going up, therefore we know that investors are now acting on the positive aspect of favorable earnings because of a strong economy and are ignoring the backup in rates. That's what's going on in 3. Ultimately, rates back up, quote-unquote, too much. Stocks roll over in phase 4 because now investors believe this backup in rates or this very weak bond market in the face of a strong economy, but investors sell anyway because they're worried that the economic expansion will shortly come to an end because of the backup in rates. So this is those 4 relationships, or those 4 phases, what you really want to know.